Concerns over unemployment has intensified as the economy grew at the slowest pace in nearly 6 years last quarter. Auto sector cuts jobs as sales failed to pick up. Layoffs in small and medium enterprises could be severe too. A quick look at the jobs portals may help us track the trends of firings and hirings in the formal sector at least. But have such online portals been at the mercy of the slowdown too? Let's speak to Managing Director and CEO of Edge, Mr. Hitesh Oberoi. He's joining us right now on the show. Mr. Oberoi, thanks very much for taking out the time. Let me ask you, how impacted or how unscathed are you with regards to the slowdown?
Well, so far so good. I mean, we've not really felt the impact in any major way. And the reason for that is that the IT sector and the IT-enabled services sector, which is about 40-45% of our revenue, continues to hire and hire well. Yes, of course, there is a slowdown in certain sectors, and that's beginning to have an impact on certain markets like Mumbai, for example. Sectors like NBFC, financial services, insurance, sectors like auto. These sectors, telecom, these sectors are now in trouble. I mean, they're not hiring as many people as they were hiring earlier, but they're a small part of our total business, so that's not impacting us to that extent as yet.
Are you seeing changes with regards to your market share in the advertising space, and are you seeing dynamics changing with the ad spends?
Not really. Our traffic share continues to be like it used to be. I mean, in the mid-70s, if you take the job portal market. So it's not as if we are gaining because our traffic share is growing or anything of that sort. It's just that, some parts of the economy are doing well, some parts are not doing so well. Parts of the economy which are doing well, I mean, it's still very, very hard to hire people. I mean, if you want to hire a good quality techie in India today, I mean, you have to pay through your nose. If you have to hire a high quality data scientist, they are almost impossible to get. So, in certain parts of the economy, there is a boom, if I were to sort of use the word. And these parts of the economy seem to be sort of hiring as if there is no slowdown, as if they don't read the papers, as if they don't watch business channels. But yes, there are certain sectors which are in trouble. And the number of sectors which are in trouble and the number of sectors which are not hiring is actually increasing with every passing month.
Do you think that, obviously, like you said, IT hiring is happening at a regular pace. Do you think that will be able to support you irrespective of whether or not the slowdown from the other pockets will have a slightly more prolonged timeline than anticipated?
Well, yes, if the slowdown worsens or if it is sort of longish, then of course our business will be impacted. The thing about slowdowns is that even if a company is not in a slowdown, but the sentiment is that of a slowdown, clients start negotiating, clients start delaying decisions, they put off manpower sort of requests, they take longer to sort of close a deal. So, it tends to have an impact on everybody, even if the company is doing well. That's the thing about a slowdown. So if the slowdown is longish or if it's, if it deepens, then of course it could have an impact on our business.
How much do you anticipate billing growth to be, for the rest of the year, in line with the average that we've been seeing in the past? I think last quarter it was about 19%.
Well, I really don't know what is going to happen going forward, but for the last 2 or 3 quarters now, we've been growing at 18-20%. And that is because, like I said, the IT sort of markets have been growing at more than 20%, and the non-IT markets are growing at about 15-17% for us. Now, if the non-IT markets slow down and growth there becomes like 8-10%, then of course it could impact our business. If on the other hand, the global economy slows down, because the IT markets are more indexed to what happens in the US and what happens in Europe than what happens in India, because a large part of the IT business is IT services. So if something happens to those markets as well, then even the IT business could slow down. So it's very hard to say what is going to happen going forward. But like I said, right now, we are seeing a slowdown in some sectors. Some sectors are okay. I don't know what's going to happen going forward.
Okay, let's talk about 99 acres. Is that an area of slowdown?
Real estate has been in the doldrums for the last, I think, almost decade now, for at least 7-8 years. The real estate market has been very sluggish. The new home market has sort of virtually collapsed. So that the real estate market continues to be tight. Prices have not really gone up in the last 6-7 years. So in real terms, of course, real estate has depreciated and not appreciated. Even today, as we speak, there is a slowdown in the new home market for sure, and the slowdown has actually deepened over the last year or so. And that is because of a lack of financing for developers and for new home buyers. And as a result, what is happening is developers are putting off new projects. So new launches are getting delayed for sure, and that tends to impact the overall sentiment in the real estate market. Now, is that having an impact on our business? The answer is still no. We are still growing, but that is more because of a secular shift, in advertising spends from offline media to online media. So that's not because the overall ad spend is growing. That's because revenues are shifting from offline to online. The real estate market continues to be in trouble.
And that will actually be the case for some time to come. The other one, obviously, where there is some amount of pressure is the matrimony business, and while you're facing stiff competitive pressures in the north and the western regions, what is the game plan there? Are you going to continue to spend more in terms of marketing and advertising to increase market share for yourself in these two main regions?
Yes, in the matrimony space, we are a challenger. We are not a leader. We are a number 2 player in the north and west, a strong number 2 player in the north and west, but a number 3 player nationally. Here, I think we're very happy with the progress we are making. Of course, we are spending a lot of money, but it's nothing compared to what other companies are spending. But that sort of extra spend is resulting in us gaining market share over our competitors. So I think that will continue. We want to continue to invest in the matrimony business. We see it as a third vertical inside the company after jobs and real estate. And, we are a long-term player in this category, and we will continue to invest.
Competitors also within this segment continue to spend money, to push their market share higher. So while you said you're a challenger in this space, does that mean that you have to, put in that much more in terms of your own internal spending to match up or try to gain, take away market share? And not just for matrimony, not just for the matrimony business, but overall, do you think the pie of spends on marketing and advertising for you is going to go up?
Well, let me answer the matrimony question first. At least we would like to believe that we are smart spenders, and we are a little more sort of frugal about the way we go about building our businesses than a lot of other players out there. So given our market position, I think our strategy is perfect. I mean, we are now recognized as a player in the matrimony space. That was not the case 2 or 3 years ago. We are a large part of the north and west markets. I would estimate our market share in these sort of regions to be close to 35-40%, which is fairly significant. So we are a strong number 2, and we would continue to sort of invest. In the other parts of the business, and partly it is also, you're right, because competition is also spending aggressively, right? And that is the nature of the game. So in the end, the stronger player will win. And this is true for the other categories as well. In the real estate vertical as well, there is competition. And a lot of our spending will be determined by how much competition wants to spend. We are happy with the way things are today. We are happy to work on product and innovation. But yes, if there is a war tomorrow in the market, we are prepared, and we will up our spends. In the job space, we are a little more comfortable. It's not as if we have to spend money. We are a leader. We are a very dominant player. We continue to work aggressively on improving our customer service, on innovating more, on improving our product and platforms, and that is an area of continuous investment. But yes, if there is a war tomorrow in the marketplace, and if competition starts to spend like there is no tomorrow, then we will be forced to respond.
Okay, can't let you go. Last question: Zomato, Policy Bazaar. What's the game plan? You said that you're looking to expand further with Zomato and 3-tier cities as well. What's the approach?
So Zomato has already expanded. I mean, they are in like hundreds of cities. They have more than 200,000 sort of delivery boys working for them. I think the game plan for Zomato is now to sort of, in general, globally, I think companies, and especially unicorns, need to be a little more circumspect about how much they're spending and how much they're burning. We don't know what the future holds. I mean, if the Uber and WeWork IPOs don't work out as expected, Uber is of course already public and the stock is down 30%. And if WeWork also doesn't sort of work out as planned, I mean, who knows, the outlook for and the fund availability to unicorns may change over time. So I think it's time to be cautious. It's time to sort of try and see if we can cut the burn and sort of slowly move the business to profitability. And that's what the Zomato team is working on. In Policy Bazaar, we are very comfortable. We have a lot of money in the bank. The company is not burning a lot of money. It's growing rapidly. We are continuing to be financial investors in these companies and continue to be supportive.